Welcome back, everyone, to our weekly market updates every Tuesday afternoon. It is April 28th, the year of the COVID, and we're going to dive right into things so that we stay on time for everyone. Again, my name is Michael LeBlanc. I'll be your host today. I'm Director and Senior Portfolio Manager at Canaccord Wealth Management. Today, though, we do have a special guest joining us. Shay from the Director of Strategic Investments at, or Investment Strategy, sorry, at Russell Investments. And I'll introduce him in a little bit, but just to kind of dive in and get to our updates. As always, this information is for general purposes. It is not advice-based. You should always seek advice of your investment advisor or confirm the information yourself. And we do try to make sure all the information is current and up to date as possible, but the information is constantly changing, and always double check everything before taking action in your portfolios. For those of you new to our sessions, we do use Zoom, so you can ask questions on the fly. If you go to the bottom of your screen there, you see that little Q&A box. You can click on that and you can type in a question, and we will definitely get to them at the end. We may address them through the session as they come in, and if it's appropriately timed. Otherwise, we'll definitely address any questions at the end. For those of you who are not familiar with Zoom, we do use an enterprise version of Zoom, so it is fully secure. Your microphones and cameras are all muted, so you're not going to show up on screen, and we won't hear anything in the background that you're doing. But if you do want to ask a question, as I mentioned, just type it in there. Every week we do try to highlight charity. This is the last 2 weeks, or this week and last week, I've been focusing on family services in North Vancouver. They help out the communities. They help out those in needs. Not just with, we did some food bank highlights in the previous weeks. Family service is a bit more broad, anything from emotional support, family support, and obviously economic support. So that's the one in the North Shore. Your communities may also have something very similar. I'm sure they all do. I recommend reaching out to them. And the other thing you can easily do is your favorite local restaurants are all struggling. Order takeout, pick it up. A lot of people have taken to buying some gift cards in order to help the restaurants manage some cash flow until they can reopen and fully get their business back up and running. So do try to help any way you can in this time of need, as a lot of people are out there struggling. So let's dive in. So by ways of our weekly update on COVID, this will be the last week I really do a deep dive into COVID. As I've mentioned in previous weeks, what we've been really looking for is economic data, and we are in earnings season. So last week we've seen a lot of companies come out with earnings. This week and next week, again, a steady flow of earnings. That's what we're going to be talking about more and more going forward, because now this is real data. We can actually work on COVID. COVID is, we'll talk a little bit here, but the curve is flattening, and we are seeing some reopenings. So barring any major changes to the COVID outlook, we are going to focus on economic data going forward to talk about the markets, as more and more that'll influence things as we go through. So what did we see with COVID this last week? Well, those reopenings, mostly in the US. We've seen Alaska start the reopenings with salons and restaurants. Restaurants are going to be limited to tables not exceeding 25% of normal capacity, so more spacing. Texas last Friday started open retail stores and curbside sales. Michigan started allowing some businesses like landscaping and lawn services, nurseries, and the likes to open, and they're rolling out more and more social distancing rules as well. South Carolina, same thing. Iowa, they started to reopen elective surgeries, which were shut down for the most part. Farmers markets can now start to reopen. In Tennessee, restaurants can reopen about 50% capacity. Colorado, Minnesota, Montana are also using restrictions to a various degree. And San Fran is one of the harder impacted areas, has extended until May 3rd, where they're putting in a plan of potentially starting to reopen. So what we're seeing is a broader reopening in the US. We're also seeing in Canada, we've got Saskatchewan, Manitoba, and New Brunswick with some limited reopenings. We're hearing talks in British Columbia of some potential reopenings. Again, as we've talked about, a phased rollout, very controlled. Social distance is going to be very important. Now, that being said, we have seen areas like Florida and the beaches becoming a little packed, and we'll keep an eye on those situations as they progress. Even over in Europe, Spain has reopened some of their parks, so allowing people out for walks, and we're seeing the same in Italy. Germany is also doing some reopening. So around the world, we're seeing that global move to phase one. And there'll be, I would imagine there's going to be some very tentative rules that are going to change and ebb and flow as we see the effects on the infection rates, and hopefully we continue those downward trends. So as always, our weekly update of the numbers, where we are at the world. We're at 3 million total cases worldwide, the US breaking through 1 million. And these are as of early this morning. So we'll probably see the US break through the 60,000 deaths probably before the end of the day if they continue at their current pace. And hopefully we'll see those numbers start to slow down. So where are we today in the markets? Well, last week, and I'm just going to shrink myself out of here so you can see. Last week we saw mildly higher in the US markets, gained mostly by technology, Apple and Microsoft. We saw some weakness in the dollar, and oil prices went for quite a ride last week, which we'll touch on in a couple minutes here. As I mentioned, we're seeing a lot of earnings coming out on this today. We're expecting Google's parent Alphabet to bring out the numbers. And we should see a slowdown there just due to cuts in spending. Facebook, the same thing, just cuts in advertisements. Apple warned of a shortfall as well, and that's mostly based on their manufacturing slowdown. Amazon's expected to rise just because the demand of online orders have continued through all this. Wednesday, we're also supposed to see the GDP numbers for the first quarter. Now, keep in mind, all the numbers we're seeing, they're great that we're actually getting numbers out from these companies and from the economy that are going to give us insight as to what the impact has been and what we can expect for the following quarter. Do keep in mind, these numbers go back to January. So some of them did not start to become affected till late February, and most of the big impact was in March. So part of the numbers are being carried by the first 2 months. So keep that in mind whenever you look at it. So when we look at the GDP growth, we do expect it to drop into the negatives, but the only effect we're really seeing there is from March on, and not including April. It's not, these won't include April's numbers. The housing sales are also supposed to be coming out this week, and we're obviously expecting to drop, although we're getting some reports around Canada that sales have continued, obviously slower numbers and volume that were in the Canadian markets, but pricing hasn't started to fall too badly yet. We'll have to watch that very closely in April and see how many of those sales in March were sales that were closings of sales that were negotiated prior to the economic shutdown. Personal income numbers are going to come out, and obviously with all the unemployment we've seen, those are going to be dropping, and we continue to see large numbers for the unemployment applications coming in. In Canada, well, we'll get into Canada in a second. And the construction spending, of course, with most of it being shut down in March, will drop as well. Technology, Verizon has put out loss of subscribers. This is not unexpected. with all the job losses, people looking for cheaper alternatives. Big oil companies are feeling the pain. A lot of dividend cuts are coming through, spending cuts, and projects being shut down. When I did this one, the Gilead's trial for their coronavirus treatment was running ahead of schedule, although they hit a hiccup along the way since then. So that had a big setback for them. AT&T announced that they're getting a new CEO, which I don't know if I'd want to take over a job like that in the middle of this, especially with AT&T also announcing losing over 1 million subscribers for their cable TV networks. Although they've blamed that on the coronavirus, they actually had a bigger loss last year at the same time. So it was a trend that was just continuing. Obviously, Boeing continues to have problems, and they had them and Embraer had a deal deadline that is likely to be delayed or potentially fall apart or changed. The Boeing, if you remember, had a lot of challenge going in this with the Boeing 737 MAX 8s all being grounded, and that situation has not cleared up yet. So we don't foresee Boeing having any positive news coming up. In Canada, the government has come out, you may have heard, to help commercial tenants pay rent, so commercial leases, where the government will pick up 50% on the tab. The landlords will discount by 25%, and the renters or the commercial companies will pay 25%, and that's for 3 months. Those applications have been flowing in. I think it started yesterday morning, maybe it was this morning, and I think there was already, in the first hour, something like 10,000 applications already pushed in through there. Not surprising. A lot of small businesses, especially even large businesses that have been impacted where they've had to close, are really struggling with cash flows. This will help delay the pain, although the companies will still have a rough go at things restarting up again. And also keep in mind, and we've talked about the REITs, or the real estate investment trust in Canada. That means they're pretty much looking at a 25% drop in their cash flow or in their revenue through this program. At a minimum, they might have some completely not pay at all, and some may just close door, which we're starting to see more and more numbers along there. The Canadian budget deficits are at $7 billion for the 11-month for the fiscal. Obviously, we're going to see that go up substantially for the calendar year 2020 with all the government stimulus that's being pumped in. Interpipeline. So this is an oil pipeline in Canada. They've secured loans of $1 billion was announced this week. So this goes back to what we've talked about in previous weeks. A lot of companies are going to be looking for credit or drawn down on existence lines of credit to wait out the storm. So not surprising there that IPL would reach out with what's happening in the oil prices. Now, they're not an oil producer, they're a pipeline, but when oil goes sub $30, the pipelines tend to trade on the commodity price, so they're being impacted quite a bit. We're seeing some movement around gold in the gold area. Obviously, the gold has been climbing, although it's not been the complete hedge that it sometimes is during these crises, but gold has been on a slow climb since almost October, November. So we're seeing a lot of movement there. More projects will likely be coming online, and we may actually see a decent year for gold mines. So oil was the big in the news last week. If you heard or you looked at the newspapers, it actually traded negative numbers last week. It fell something like 300 and some odd % in the price in one day. I did a whole video on that. If you follow us on YouTube or on our webpage, you can click a link and watch that, a detailed report on why that happened. It doesn't necessarily mean the oil is trading in negative all the time. The big, to summarize the video, and we'll put a link, if you rewatch this on a replay, we'll put a link to the oil video at the bottom here. Or if you'd like us to send you the link, just fire us a message. We'd happily do that. But the big reason we saw that was lack of storage. Oil supply is far outpacing demand right now for a lot of reasons. OPEC and some of the oil producing countries were slow to make changes there. And we got to the last trading day for oil futures for May deliveries. That means the oil had to be delivered. And the US was basically out of storage, or very, very limited storage. So that was the major problem that caused that. It started the trading up after that, although we've seen continued weaknesses. I was looking at it this morning. WTI was trading around $12, $13 this morning a barrel, and Brent crude was trading about 20, and those are just different markets. But that basically what we're seeing right now is all the countries out there looking to see how they can expand their storage. The U.S. is looking at to build new facilities at their critical storage capacities in Cushing, Oklahoma. But that takes time, and even if they speed up construction, it will take 3 to 4 months to even get it going. Super tankers, the rates spiked to rent a super tanker because you can store it in their holds, and we've seen a little bit of easing since that contract crisis happened, but it's likely if we get into the June contracts that will spike again. There's a lot of pressure on the governments to include stimulus for the energy sector, especially in the US, but there's still a lot of pushback from the Democratic parties in the US. That, there's been so much buildup over the last 10 years, but certainly in the last 2 or 3 years around clean energy and the problems with fossil fuels for the environment. There's a lot of push, not just in the US, Canada as well, internationally, a lot of push for the stimulus funds to go into new energy, longer term viable energy, cleaner energy, as opposed to bailing out the oil companies. So it'll be interesting to see how that plays out. The thing that we're really watching is what the oil companies are doing. As I mentioned, they're having to cut prices, close projects. We won't see any expansion of capacities. We're actually seeing shutdowns. Last week we saw the US government have Chevron shut down their Venezuela production. We'll see more and more of that just to try to curb supply while demand remains low. And even when we start to reopen things, cars are not the big users. It's really industrial. Airlines would have to increase their demands again back to pre-COVID levels for us to even get close to the surpluses in capacity that we have going right now. So oil companies are going to struggle. They really can't make money below the $30 level, or at least most of them are very challenged with that. And hopefully we'll just see a little bit more cheap gas, although it's kind of ironic that gas is really cheap when we can't go anywhere. I don't think I filled up my tank in over a month and a half, so hopefully it stays cheap long enough for me to have to go out and buy some. So as we always do, we go into what's next, what's coming up in the markets, and we have our special guest today, Shailesh Kshatriya from Russell Investments. If you're familiar with Russell Investments, they're a great firm. They're one of my main go-tos for information. Shay is one of those key contributors to their global outlooks and investment strategies, not just here in Canada, but around the world. And we're very fortunate to have him with us here today to give us his views and his insights. So I'm going to turn this over to Shay. And
awesome. we go. Good morning, everyone, and just give me a second while I get my screen set up here. Okay, hopefully that's coming through okay at your end. So thank you, Michael, and good morning again, everyone. And I think to Michael's sort of last point on the oil prices and how unusual, it is to have negative oil prices. I think these are, it's often overused a word these days, but it is quite unprecedented. But anyways, thank you once again, Michael, for allowing Russell Investments to provide an update. What I thought I'd do today would be to just, we'll probably start 10,000 feet and then kind of narrow in as we go through the conversation. And I'll start with a broader market perspective, just give a bit of a historical perspective on the markets. And then dive a little bit into the rally that we have been seeing and observing over the last several weeks and what's been driving that. And then we'll close out with our outlook and perspectives going forward. So, with that said, I think I'll start here. So I think these are quite unprecedented times, and I think as I said, Michael was talking about negative oil prices, and this quote comes to mind. There are decades where nothing happens, and then there are weeks where decades happen. It just seems like the last several weeks, it's like a decade's worth of economic events have occurred in such a small time period. But be that as it may, what I find interesting is when you look at the longer term history of the stock market. So this is using just the U.S. equity markets, starting all the way from the 1930s, basically the Great Depression, all the way on to the present environment. And what you'll notice is that we've gone through lots of different types of economic events, macroeconomic shocks, whether it be political in nature, economic in nature, geopolitical in nature, or what have you, which can contribute to recessions. Certain recessions are shorter in nature, less than a year, and some, of course, can be slightly longer in nature, at longer than a year. But the point being that, the avenue through which we got to the current economic environment is perhaps different, and it always is, right? No two economic scenarios that we're highlighting here on this chart here are identical. As we know, they're all very different. They're all very unique to the specific circumstances of that point in time. But this time, in a sense, is a little bit different. And we'll talk to why that is. But the real, the punchline of this slide is that it illustrates that even though we go through all of these various economic shocks, and it can cause, pullbacks in the equity market, some more severe than others, the bottom line is the world is a going concern. We do eventually rebound and get past it and make new highs and keep going and keep pushing forward. So what is different this time around, I think, is worth illustrating because, historically, if you think about many of these recessions that we've endured in the past, usually and more often than not, what contributes to that recession is what we say an economic imbalance, right? So whether it be elevated household debt levels or what have you, there is an economic imbalance that's brewing in the domestic economy, in the global economy, which eventually results in the economy tipping over into recession. And I'm obviously oversimplifying it, but it's usually an economic imbalance that leads to an economic recession. This time around, obviously, we know it's been a little bit different. And it's not to say that we didn't have any imbalances. Obviously, considering that this was one of the longest economic expansions on record, clearly there were some imbalances, but nothing that was outright glaring. So what really contributed to this crisis that we're in right now, the recession that we're either in or getting into very, very soon, is the fact that first and foremost, this was a health crisis, right? This is a health crisis which evolved into a pandemic, which then eventually resulted in the global economy entering into this recessionary type of environment that we find ourselves in. And when you think about how do you combat this healthcare crisis that we're feeling right now, well, that we're enduring right now, well, obviously we know ultimately, and Michael kind of touched on this, vaccines and treatments. Those, I mean, obviously that is what we eventually want to see, some validation there, but we also know that will take time. So in effort, you can think about it this way, in an effort to actually support the healthcare system, whether it's the US, Canada, or global policymakers, effectively what they had to do was shut down their respective economies. So this, in a sense, what makes this one so different is that this was, in a sense, a forced recession. And that's what makes it a little bit different, because it was that forced recession, closing of businesses and economic activity, which eventually has resulted in the downturn that we have seen in the financial market. And I think that's really what separates this crisis apart from several of the others. Now, before I move on, if I was to make one analogy with regards to the current the current sentiment, if you will, in terms of how people are feeling versus some of the times past, I think the one that really comes to mind is probably 9/11. 9/11 was a point in time where there was clearly an emotional a sentiment shock, if you will. And at that point in time, obviously, it was a concern more on security and safety, personal security and personal safety. And that was also a point in time where you did see, closures of businesses. The airlines obviously were shut down for about a week or so. And then obviously this time around, it's nowhere near nothing similar to what we saw in 9/11. But from an emotional perspective, we do have that personal fear as it relates to our own health this time, not necessarily our security, but our health. But so there are some subtle similarities, if you will, there. But clearly this time is rather unique. Now Michael kind of touched on this with regards to the market resiliency, and we have seen the markets be quite resilient over the last several weeks. Now, this chart here is just highlighting returns as of the first quarter. But what's interesting is if you actually fast forward and think about returns that we've seen over just the most from a year-to-date perspective, is that equity market, so the TSX, if I look at the current equity market returns, the TSX, we know from peak to trough actually was down around 37% at one point in time. Year-to-date so far, it's down about 14%. And over the last 1 year, it's down about 10%. So that's quite remarkable when you think about the drawdown that we had seen when we think about those peak to trough declines. And when you marry, the declines that we saw where we are at the moment being down, let's say, 14% or so, or over the past 1 year being down around 10% or so, and you kind of reconcile that with 2019 returns, it's just, in a sense, we've given up a lot of what was earned during 2019. And quite frankly, in 2019, if someone was told at the start of 2019 that U.S. equities would do 24%, Canadian equities would do very similar returns, around 23%, I don't think too many people were actually expecting those types of returns. So in a sense, what has occurred so far this year is just we've just given up a decent chunk of those 2019 returns. And equities obviously have clearly rallied quite significantly. In the case of Canadian equities from the bottom, Canadian equities are up now almost 30%. Again, quite remarkable when we think about where we were at one point in time. So the natural question is, so what has obviously resulted or contributed to the rally that we've seen in the financial market? So there are really three key themes that kind of stand out to me. But first, maybe we should, this one right here, yeah. So this chart tries to encapsulate all that has been occurring from a global stimulus perspective. And quite frankly, it's a moving target, as we know, because the stimulus measures just continue to, if anything, increase. And this number, which is captured as of the quarter end, March 31st, the total number there is actually is higher. I believe the number that I saw more recently is the total global stimulus is approaching closer to $9 trillion. The Canadian number here itself, which suggests 56 billion, we know that was one of the initial estimates, and now we're well north of 100 billion in Canada as well. So these numbers have just grown, and obviously the stimulus itself has been one of the key sort of underpinnings as it relates to the most recent market rally that we have seen from the bottoms. And it's not just the federal stimulus, obviously, which is highlighted here, but it's also from the central bank side of things. So whether it's the Bank of Canada, the US Federal Reserve, or their global counterparts, they've all been providing a stimulus. Now, when I think about all of the stimulus that's coming through from policymakers, whether it's the federal government that we're highlighting or the respective central banks, there's really two ways I think about. There's two core sort of reasons why. And it's liquidity and solvency. So, you know, we talked about how businesses, in a sense, are being forced to shut down, right? These are forced business closures, which is, in a sense, closing off businesses and therefore households, because forced business closures means household, the unemployment rate, as we know, is starting to tick higher quite dramatically. So what you're having is almost in an instant, you've seen businesses who had steady revenue, that revenue has dried up, and households which had a steady paycheck, that paycheck is no more. So and this was in a sense forced upon by the federal response to combat the healthcare crisis. So in the interim period, what was necessary is, of course, liquidity. So the federal response are some of the numbers that we're seeing here. And then from the central bank perspective, the liquidity that they're providing is to the financial markets. And obviously the federal government is providing liquidity to businesses who've seen their cash flow tied up, just freeze up, as well as households, similarly, who are going through economic disruption. Their liquidity has also dried up. So this liquidity, in a sense, becomes very important because it provides that bridge for households and businesses to actually get to the other side and ensure solvency, right? So once the global economy starts to renormalize, we also obviously want to ensure that we're not only liquid right now, but that liquidity, in a sense, is necessary to actually get towards solvency as the global economy starts to renormalize, businesses start to reopen again, and economic activity starts to pick up. So you need businesses and households to be solvent to get to that other end, which is why the stimulus has become so critical. The other point is, and Michael touched on this as well, as to what's been contributing to or has contributed to the market rally, is the actual perhaps silver lining, if you will, with regards to these containment measures, that they're starting to show some positive outcome, in the sense that the case counts have started to plateau. We've seen the growth rate and infection rates actually start to come down. Obviously, Asia was well ahead of North America and well ahead of Europe. They've been opening up again. We've seen several European countries start to open up again, and obviously North America is probably a couple of weeks behind Europe, and there are obviously certain states that have started to open up, as well as certain provinces which have either started to or are obviously contemplating opening up. So with regard to the timeline, obviously it is very fluid, but in a recent sort of research, what we tried to do was, in the US at least, what we tried to do was take account for the current projected phase one opening dates across the 50 states, and try to put together, well, what, based on the information that we have right now, when will all of the United States be close to 100% open on a phase one basis? Obviously, this is all happening in phases. And based on the measures that we know right now, the projection is to be somewhere around mid-June to late June. You know, roughly 100% of the United States are expected to be open again on a phase one basis, because this will be gradual. But that obviously is getting priced into the financial markets as well. So it's a combination of the stimulus. It's encouraging signs that these very strict measures that were taken to slow the rate of growth are actually showing some benefits, and that is allowing for the global economy to gradually start renormalizing, and obviously has been critical. So with all that said, then, what is sort of our baseline scenario when we think about our outlook? Well, we do believe that it is a tale of two halves, if you will. So the first half of the year, and we don't need to get into all the specifics on all the different regions, but we do believe that, and I think you can kind of summarize in a sense that the first half of the year it's almost a write-off because of the business closures, the economic impairment that entails. We know that the first half is going to be a bit of a write-off. The second quarter in particular will be exceptionally weak from an economic growth perspective, but in so much as that reopening that we discussed actually comes to fruition, and obviously it is a very fluid situation, we do expect that over the second half of the year, when we start thinking about a rate of change from an economic growth perspective, when you think about third quarter GDP growth relative to the second, and the fourth quarter GDP growth relative to the third quarter, we do expect that gradual renormalization of economic activity that takes place over the second half will actually result in pretty meaningful positive GDP prints for the global economy once we start looking at a quarterly economic growth for the third and fourth quarters. Now, obviously, for 2020 as a whole, we know there will be some permanent damage that will take place because of the pretty severe downturn that we do expect over the first half. But we do see that silver lining in the sense that the second half, we do expect the second half to be a little bit stronger, in so much as this normalization continues. Now, I'll just add maybe a couple of points on Canada in particular, because the Canadian economy, the global economy is obviously in sort of, we're all in the same boat as it relates to the economic shock that's coming through from the COVID crisis. But I think Canada is a little bit unique in the sense that, there is really a trifecta of problems, in the sense that, of course, the economic impact from COVID in and of itself, Canada is clearly not immune to that. So there's a shock from that. Michael obviously touched on oil prices. Obviously, energy, the importance of energy in a sense has reduced over the last, let's say, 10, 15 years or so, but it's still a key component of the energy of the Canadian economy. So lower energy prices and the volatility there clearly remains a concern. And then the final point being, and Michael again talked about the housing market, household debt levels are still around historic highs. So that, when you think about the recovery, could be a bit of a headwind for Canada as well, as economic activity starts to renormalize. We still think Canadian economy will also grow over the second half of the year. What we do believe that obviously there's a few more unique challenges that Canada has to deal with relative to, let's say, a country like the United States. So, that being the broader global perspective or outlook from an economic perspective, from a broad asset allocation perspective, where we've been sort of repositioning or positioning our portfolios, I should say, is that, one thing we know is that the U.S. equity markets, that's been one of the only, here's the slide. U.S. equity markets have been, in a sense, the only game in town for quite a while now. But what that has also meant is that the U.S. equity markets are also one of the most expensive markets in the planet, irrespective of all the, you could pick any different measures, whether it's price to equity, price to book, price to sales, enterprise value to EBITDA. Obviously, we're just showing a couple here, but U.S. equity markets are quite expensive. Now, valuations have improved relative to what they were given the pullback, but obviously we've seen a bit of a rebound still. So U.S. equity markets remain pretty expensive. So we do have a preference for international, where you also get a bit more of a dividend yield as well when you think about the income component. So we do think that the international equity space, international markets, and then eventually even emerging markets offer better value. So from a geographic perspective, that's the area that we continue to look at and monitor. From an asset class perspective, we continue to like the real assets space. Yes, there is volatility, but over the longer time, we think it's a nice a broader diversifier, and historically they do tend to be a little bit more defensive in nature. So we still we believe that remains a key component of a broader asset allocation. Given the pullback, and we talk quite a bit about the equity markets, we also know that fixed income markets experience a bit of volatility, especially corporate credits and high yield. So that's an area that we're actually that we've been adding to corporate credit, as well as the high yield credit space, where we see valuations getting a lot more attractive given the distortions that we saw take place over the first quarter. But so those are sort of the broad asset class views. But I think the key point, I think, going forward is that we should expect volatility to continue. I think that's it's going to take time for things to really normalize. When we talk about reopening, we're really talking about phase reopening. It's not just a wholesale 100% things are normal. We know that. So which in and of itself means that there will be volatility along the way. From a financial market perspective, but I think just having an asset allocation, having a plan, working with an investment professional, I think those are all very critical components to longer term success. And before I close off, maybe I'll end with this. So the slide that I have up here right now, the analogy being, let's say, well, hopefully at some point things do broadly open up and we're able to go to Las Vegas again. And you were told, if you go to this particular casino and play this particular game 7 out of 10 times, you're going to be positive. Now, to what degree you will be positive can vary clearly, but the fact that 7 out of 10 times you will be positive, I think more often than not, you take those bets. You take that odd, given that it's overwhelmingly to your side in terms of a rate of return being positive. And if you were then further told that, over 5 to 10 years, if you continuously played that and did it methodically, that the probability of being positive close to, or if not 100%, I'd be all in. Well, that's what really a diversified portfolio provides, right? So this slide is just giving a broader perspective on, irrespective of what kind of asset mix you have, whether you're a little bit more aggressive with 70% equity allocation or a little bit more conservative with 30% allocation, anywhere from 1 month out to 10 years, you're looking at being positive anywhere from 70% to about 100% of the time, in so much as you stick with that plan, do rebalancing and what have you. So the bottom line is, and maybe I'll close here, is that we do expect, the choppiness to continue. I think that's a key point. But when we start thinking about our broader perspective over the next 12 to 24 months, obviously it's being underpinned by the coordinated, in a sense, stimulus, both from the fiscal side as well as the monetary side, which will then support the gradual renormalization in economic activity, which obviously then keeps us a little bit more constructive on the outlook when we start thinking about the financial markets on the 12-month horizon. So I'll pause there, Michael, if that's okay.
Perfect. Thank you, Shay. Thank you very much for taking time out of your day. And I do like that you use Vegas as an example of where we should go back to, given what their mayor was saying earlier in this week. So everyone, just bringing up my screen here. Get to where we are. So just a reminder, I do work for Canaccord. We have part of our disclaimers here. So I work for Canaccord. We're a global company based around the world: UK, Australia, Canada, Asia, and head office here in Canada, obviously in Vancouver. Shay obviously did a much better job than I usually do, because I was just going into the question area, and we have no questions this week for the first time. And that's great. Shay covered off a lot broader topics than just the Canadian market that we usually cover, which is perfect. So I thank Shay. I thank Russell Investments. Thank you, everyone. As always, this will be available for replay. Do take the opportunity to forward and share it to any of your friends that may be interested. We will be back next Tuesday at noon. and keep an eye out on our channels for any breaking news. We're doing special little snippets as news breaks throughout the week. Thank you again. Take care and stay safe, everyone.